It might seem impossible that someone with the income of a gas station attendant or a janitor could amass a fortune worth almost $8 million, but that's exactly what Ronald Read did. This wasn't the result of a huge lottery win or a massive inheritance from his rich relatives either. He built his fortune by utilizing tools that are readily available and strategies that are easy for just about anyone to implement. How would someone with such a low income even have enough money to pay his monthly bills, never mind invest aggressively for retirement? When disciplined, even those earning a below-average income are able to become multi-millionaire philanthropists. Let's take a look at exactly how he was able to build such a fortune through earning, spending, and investing, and how you can do exactly the same. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. After serving in World War II in multiple countries overseas, Read returned to his hometown of Brattleboro, Vermont. For the next 25 years, he didn't earn much money as he worked as a service attendant at a gas station that was owned by his brother. This led Read to his eventual retirement, but the lack of structure and boredom that many retirees face led him back to work. At this point, he worked as a janitor at a JCPenney store until he retired again in 1997. Read's second retirement lasted almost 20 years until he died at the age of 92. When he died, he left the majority of his money to his local hospital and library, surprising his community. His close friends and family were especially shocked at the size of his estate, having no idea that he had so much money. How was he able to become so wealthy, having worked low-paying jobs his entire life? When Read died, he had a 5-inch thick stack of stock certificates. He bought stocks for the long term with no intention of trading. Currently, most people are able to buy and sell investments from the comfort of their own home using their phone. While this is certainly convenient, there is an advantage to the older, more traditional way. Read kept those stock certificates at the bank in a safety deposit box. This means when he wanted to sell a stock, he had to physically go to the bank to get the stock certificates. Then, he had to drive across town to the office where his investment accounts were held in order to execute a sale. This extra effort required makes it less likely that you'd be buying and selling investments routinely. This is beneficial for a couple of reasons. First, you're going to be careful when making your purchases. You're not going to buy a stock or fund spontaneously without careful consideration due to the tedious process of buying and selling. You're likely going to make a purchase with the intent of holding it for a very long time. Second is that your chances of panic selling are greatly reduced. Since it's more difficult to unload a stock, you're less likely to panic sell during times of uncertainty. When you invest for a long period of time, it's so easy to become extremely wealthy. Due to compound interest, the value of your investments snowballs and the growth picks up speed. This is one advantage Warren Buffett had. He began investing in stocks when he was just 11 years old. He's 91 now, meaning he's had a lengthy 80 years of compound interest helping him out. An excellent representation of compound interest is the question, would you rather have a penny that doubles every day for 30 days or $1 million? The penny would have grown to about $5.3 million after 30 days. If you ask the same question but change the doubling time to just 27 days, you'd only have about $671,000. As you can see, almost all of the growth happened in the last 3 days. This is why you're told to begin investing as early as you can. When you take care of your health and plan on living for many years, time is on your side and it's easier to become very rich. Most of us aren't going to be living into our 90s, but Read didn't even begin investing until he was 38 years old. When it came to buying companies, Read didn't get caught up in the hottest fad at the time. He primarily owned dividend-paying blue-chip companies like Procter & Gamble, JP Morgan Chase, and Johnson & Johnson. These are large, well-known, stable companies with no expectation of fast growth. With a portfolio of about 100 stocks, he kept his portfolio well-diversified across many different sectors. Being well-diversified will reduce the risk of losing it all when one area of the market turns into a bubble and consequently does very poorly. The key to diversification is to avoid de-worsifying, which is what successful investor Peter Lynch calls it when you expand into lower-quality investments just for the sake of spreading everything out. It should come as no surprise that Read was extremely frugal, since his friends and family had no idea of the size of his fortune. He drove older, reliable economy cars that were inexpensive to maintain and were fuel efficient. His wardrobe was so underwhelming that he reportedly even had a meal at a restaurant paid for because his appearance was so rough. While his approach may be a bit extreme, frugality is an important lesson to learn. Instead of wasting money on random items that are meaningless and provide no real value or happiness, only buy things or spend on experiences that are important to you. In a way, Read was very lucky because he loved investing and that was what made him happy. Investing in individual stocks can be risky, especially when you don't know how to select quality companies. Read made some excellent investments, and sometimes it only takes a couple of them to become extremely wealthy. However, his strategy is risky, and he did buy some losers, like Lehman Brothers. An excellent alternative to individual stock picking is to purchase an ETF or exchange-traded fund that allows you to purchase a basket of stocks at one time. This is a more practical approach for regular investors who want to become wealthy with lower amounts of risk and with far less research. A popular option is an S&P 500 ETF such as Vanguard's VOO. This will provide returns that track the market, averaging a 10% return per year since it was first established. A more aggressive alternative is a growth ETF like Vanguard's VUG. In theory, this fund is higher risk and higher reward. Over a long period of time, this will be more volatile than the S&P 500 fund, but is aimed to provide higher returns. In both cases, you're owning hundreds of different companies without the burden and risk of selecting each of them on your own. Read was an investor for approximately 55 years, from when he was in his late 30s until the time of his death in his early 90s, making achieving a portfolio of his size relatively easy. How much would you need to invest over a 55-year period to achieve an investment account of his size? For this example, we will use the $10 million mark as an inflation-adjusted equivalent of Read's $8 million. Let's say you start with nothing and invest $2,300 per month. With annual inflation adjustments to your contributions and earning an average rate of return of 10% over a 55-year period, you will have about $10.1 million adjusted for a 4% inflation rate after 55 years. Now, if you are able to achieve a 12% annual rate of return, you'd only need to invest about $1,100 per month with inflation adjustments to earn the same amount of money. As you can see, it's possible for nearly anyone to build wealth, given enough time in the market. When you invest for a long period of time like Read, compound interest really begins to accelerate. In the example of the penny doubling, almost 90% of the money was accumulated in just the last 3 days. Purchasing quality investments, ones that you don't plan on buying or selling often or even ever, is another key to this strategy. You don't need to be a master stock picker. Even someone earning an average rate of return can do just what Read did. Don't spend your entire life hoarding every penny in hopes to become extremely rich. A healthy relationship with money involves a balance of investing and spending on the things you enjoy. Read was lucky in the sense that much of his joy came from the thrill he received by investing, picking winning stocks, and seeing his money grow.